Sarah Snell Cooke, your host for the Credit Union Connection. We're here today with Aaron Duffy from CU Strategic Planning. Welcome.
Thank you, Sarah. Glad to be here.
Yeah, awesome to see you again. We're going to be talking CDFI. There's been so much chaos over there, and then nothing happening at the same time. So tell us a little bit more about yourself and CU Strategic Planning and what you do.
So I'm Aaron Duffy. I'm the SVP of Community Advancement. I oversee our grant development and certification services. CU Strategic Planning has been around for over 2 decades now, and we are the industry leader for credit union CDFI services. We write grants, we do strategic planning, we do executive search, all things CDFI related. That's us.
Yep. Yep. Great work you and your credit unions are doing. It's amazing. Some of the credit unions that I get to interview for you all and their stories. But today we're talking a little more on the compliance side because things have been kind of chaotic at the CDFI fund. And then if you don't know, that's Community Development Financial Institutions Fund, and CDFIs are Community Development Financial Institutions. So, Aaron, talk about the biggest topics that are coming out of CDFI that you're getting questions about from credit union leaders.
I think the biggest question right now is, what does the future look like? Is the CDFI fund on good footing? Are they at risk? Are the programs going to continue? So back in March of this year, an executive order came out that targeted a number of agencies. The CDFI fund was one of them. And I would say at this point, the administration had learned some lessons about how to get agencies where it wants them to be. And the executive order was relatively targeted in that manner. What it did was ask the agencies to determine which of their programs are statutorily authorized and which aren't. And so they were trying to avoid the argument that they were overreaching, stepping in and getting in the way of Congress. That caused some pause in the industry. Thankfully, we saw a lot of positive come out of it, a lot of bipartisan support for the CDFI fund, for all the things it's accomplished. The CDFI fund has enjoyed broad bipartisan support since really its inception. It's well backed in science, lots of studies about the impact. And we saw that support come out after this executive order. At the end of the day, Secretary Bessent said all the CDFI funds programs are statutorily authorized, and so there's no real risk at that point. Still, understandably, credit unions are saying, should we be concerned about this? At this point, we've seen a proposed budget in the $270 million range, I think, from the lower house. We'll probably see something more than that in the Senate, full support by the Treasury Secretary. So really, we don't have any basis to be concerned. There were some rocky months there, but everything looks good right now. And so we're encouraging credit unions to stay the course and let's move forward as if everything's normal, because really all the signs are pointing that direction.
Yeah, and that's good to hear, because obviously community development financial institutions are kind of the backbone of their communities and the communities they serve, because these are people generally who have been overlooked historically, and really need access to financial services, including especially probably credit. Building credit is so important to everything we do. And so, what do you see as or what kind of credit questions are you getting from credit union executives regarding the different changes at CDFI fund? I mean, they've been through a couple administrators, and just prior to like the executive order, you were finalizing or the CDFI fund was finalizing the way it was certifying because it changed that up, and then a lot of credit unions had to get recertified to stay CDFIs. So how is the new executive order affecting that? Let's start there.
Yeah, it really is a time of change, which has been unsettling for a lot of credit unions. I I would say the executive order just added some additional uncertainty on top of the uncertainty that already existed. For some context there, since the mid-90s, the CDFI fund has never made CDFIs recertify once they're certified. There's an annual reporting requirement, but
Mhm.
it's if you're meeting that requirement, once you're certified, you stay certified. In December of 23, a culmination of about a 3 or 4 year process came to fruition and new rules came out. And it required all CDFIs to go through a really extensive recertification process. And not only that, it added a couple of different layers of complexity of things that the CDFI fund was not looking at before in regards to certification. So we're adapting to new rules and we're going through this new process. We start our credit unions off on that process, and then multiple times in 2024, the CDFI fund made some pretty substantial changes to the rules and to the process. And so credit unions have had to be nimble, have had to adapt. And it's been a pretty big administrative burden on our
Mhm.
clients. It's been a long process. Many of them have been going through it for 20 months now. And that just really speaks to their commitment to their communities and the importance of the CDFI designation and the resources they have access to and how that supports their missions and their service of their communities.
Mhm. And I understand you're just starting to hear of certifications being finalized.
We are. Yeah, we
Yeah.
submitted a handful late last year. It's taken the CDFI fund much longer than we had hoped to get those turned around, but starting a couple of months ago, we've seen a couple come trickling out. All good results, but it's been a slow process.
Yeah. Well, it's federal government. Everybody is slow but Trump, basically.
Pretty much.
He's been having everybody moving fast. Um, so, how has this affected the existing CDFIs and I want to say kind of their mental resilience?
Mhm.
Um,
Yeah.
how is that going? I mean,
I think that the fact that we knew this was coming was helpful to some degree, but you don't really know the extent of it until you get into it.
mhm,
And it's hard to estimate how many hours the credit unions have had to put into this, dozens and dozens and dozens. And at the same time, they're doing core conversions and they're doing mergers and they're rolling out new products and they're assessing needs in their communities and all the things they need to do to run their community, run their credit unions and serve their communities well. And then on top of all that, they have this massive recertification. So it's been difficult. Um,
yeah,
it's a lot of data they have to collect. There are a lot of questions that the CDFI fund is asking that they've never asked before. So that causes a lot of discussion and takes a lot of time. Um, at the same time, we're getting through it and we're planning on submitting dozens and dozens by the end of this month and being pretty much wrapped up with this round by the end of September.
nice, yeah. And so, what are some of get into the little bit of the nitty gritty? What are some of those questions or that the CDFI is asking that are new?
One of the big ones that's causing the most concern is overdraft and
Mhm,
NSF. The CDFI largely followed the CFPB's lead on thoughts on those programs, and we all know the CFPB had some big questions and had some guidance, and in general wasn't a big fan of those programs. The concern initially was the CDFI going to say, hey, no more overdraft, no more NSF? Thankfully, they didn't go that direction. What they did was they said there are some practices that we don't love, but will allow you to do. If you do them, we need some explanation of why they're consistent with a community development mission.
mhm,
Those practices were charging fees more than the item being charged, um, charging more than 6 overdrafts in a rolling 12-month period, and then charging more than one NSF fee on a single item presented. So if an item's represented, if you charge another fee on it, they didn't like that. They didn't say any of those practices were prohibited. They just wanted to hear why the credit union could engage in those and still be serving their members. And there's lots of good arguments uh,
Mm-hmm.
why those things go on. Some of them are technological limitations. A lot of core systems won't recognize representments. I haven't found a single core system yet that can track on a rolling 12-month basis whether a member has charged up to 6 overdrafts or not. So some of it's technological, some of it's more practical, some of it's we're trying to serve our members well and meet them where they are, meet the needs they have. And something like overdraft is a much better option than any other option they might have, like a payday loan uh,
Mm-hmm.
or pawn or something like that.
Yeah, absolutely. I saw data, or it was on LinkedIn the other day where um, a person got a loan for, I think it was about $900, and including all the interest they would be paying, in the end, they would have paid $5,500.
Yep.
And for the you don't have to comment on this, but for the CFPB and others to be complaining about banks and or credit unions, especially credit unions, of course, you know, $25 when you overdraft $100 or whatever. I mean, it's not great, but that is a massive difference
Mhm.
from 6 times as much.
Right, right. And to be fair, there are bad actors out there, and even more nuanced, there are entities out there that are maybe not as thoughtful as they should be in their overdraft and NSF programs, and
Hmm.
there are some legitimate concerns. What I've seen, we've worked with well over 100 credit unions through this process, is that the vast majority are very thoughtful. So
Hmm.
they're reaching out to their members, they're providing free financial counseling, they're putting limits on how much can be charged. It's for the vast majority, this is not a cash cow, it's a service. Yes, there is a cost to it, but there's a cost to run it. Um,
Yes.
so while I think there are some legitimate points to be made, at least among the CDFI credit unions we work with, is there a widespread abuse? Certainly not.
I'm going to ask you to predict here. So, under the Trump administration, do you feel like some of those things could get rolled back? Is there any whispers about that? Not those things, the things to clarify, the things that the
Sure.
CDFI fund put in place, at the end of, or not put in place, but put in place in the last administration.
Yeah, there's speculation, but nothing beyond that at this point. The
Hmm.
like you mentioned, the federal government is it's a big ship with a tiny rudder. It takes a long time to change anything typically, and the changes were in process for years and years and years. So to reverse those at this point, I think would be a major undertaking. I
Hmm.
personally do think we're going to see maybe that there's not as much need for concern in some of the
Hmm.
things that they were looking at. For example, ODP and NSF. Um, the the CDFI fund was following the CFPB. Well, the CFPB has been largely sidelined at this
Hmm.
point, and I think that changes the political calculus and the thinking of the CDFI fund. So while it's still something that is going to be examined in the recertification, do I expect to see broad denials of recertification because of concerns about ODP or NSF? No, not at all.
Okay. So it's more in the nuance than the actual regulation and or executive orders.
Right. I think so.
Yeah. And so what is going to happen with after the recertifications? Obviously we're still waiting. You said they're starting to trickle in, but obviously still waiting on a lot of those. And because there are far more than a couple of credit unions that are CDFIs. Um, how do you think that is going to affect going forward? I know there were certain requirements that were new to be recertified, and
Mhm.
is that going to affect how credit unions move forward once they are moving forward?
Yeah, it's a good question, and the rules are wide ranging. Um, what we saw in general was that most credit unions were already complying with all the things the CDFI fund wanted to see. So we didn't see a lot of need for change. I'll give you an example. The CDFI fund does not want CDFIs selling debt to third party collectors. They're okay with a credit union hiring an attorney or a debt collector to collect on the credit union's behalf, but not fully selling the debt. The concern being, once you sell the debt, you don't have control over how it's collected. Maybe there are abusive practices and so forth. Well, in general, the vast majority of our credit unions didn't do that anyways. Some did, and had good relationships and good reasons to do so, and so they had to change their processes. But the vast majority did not.
Mm-hmm.
Another example might be adjustable rate mortgages. The CDFI fund wanted to see that lenders underwrite adjustable rate mortgages at the highest rate they could reach in the first 5 years of the life of the loan. And the idea there is if something goes wrong and the rate goes way up, you want that mortgage to still be affordable, right?
Mm-hmm.
Well, a lot of credit unions were already doing that sort of thing. It's they don't want to put their members into a mortgage that they're not going to be able to afford. They're not setting their members up to fail. So a lot of this stuff, while it was something that, yes, we had to check the box on, it's not something that is creating large operational changes.
Yeah, yeah. Well, that's good to hear at least. And I think that's interesting about uh the stopping the outsourcing of debt collection because in particular with credit unions, if you're using a QSO that have either an investment in or just some kind of say in how that functions, I would think that would be credit union-y enough. But yeah, I also see where it's difficult to, allow credit unions to do that, not banks. I think there would be a complete uproar.
Right. Well, and most were doing their collections in-house or with the help of an organization that they still had control over.
So, Aaron, what I know some of the changes was about lending requirements in the regs, and so how is that affecting credit unions going forward?
Yeah, so the high level requirement is still the same that it has been, which is in general 60% of your lending needs to go to your target market. And target market's very nuanced, but in general, it's the low income, underserved
Hmm.
borrowers that you're serving. So that generally stayed the same, but lots of little nuances underneath that rule changed, and it made it more difficult for credit unions to hit that 60% required threshold.
Hmm.
So we saw in general target market lending percentages drop, not because the credit union's activity changed, but because the way that target market lending was being measured changed.
Hmm.
What that did is it brought a lot of credit unions closer to the threshold than they were. So they might have been at 70, maybe they dropped to 65, or they're at 80 and they dropped to 70. And what that means is that credit unions that want to maintain their CDFI designation need to be very careful and cognizant of where their lending is going. And that 60% test is being tested every year, looking at the prior year's lending.
Hmm.
So it's really something you have to keep top of mind to ensure that you can meet that test when it comes up again the next year. If you don't meet the test, there are some things that you can possibly do, but in one way or another, it's going to put your designation at risk. And so it's something that we're working with credit unions on tracking and on ensuring that they're going to meet those thresholds.
Hmm. And for those who may not know, explain a target market.
So a target market is a complex and nuanced concept. But in general, it's the underserved and low-income borrowers that you're lending to. A little more granular, your target market consists of what the CDFI fund calls components. Most target markets are going to consist of a low-income component and what the CDFI fund calls an investment area component. And what low income is, it's low income borrowers, and the investment area are low income areas. So any loan you make to a low income borrower is likely going to be in your target market. Any loan you make in a low income area is likely going to be in your target market. After that, it really becomes particular to the credit union on what they want to bring into their target market. And there are administrative and compliance burdens, the more complex you make your target market. So we tend to try to keep the target markets as simple as possible.
How have the new certifications affected the participation of credit unions and others that are CDFIs? Yeah.
It's quite a challenge to get through this application. I don't know how many pages of guidance we're up to, well over 800. I think this point, the application itself is well over 100 pages. This is not an easy thing. And we keep our pulse on the loan fund CDFI world as well. And we're seeing, especially among loan funds, which tend to be smaller, tend to have fewer resources than credit unions, they're really struggling to get through this application. Like I said, we've been working with some credit unions 20 months on this, and it's taken every bit of it to get through it. And we're seeing conversation in the loan fund world that they're asking each other, should we get started on our application? And it blows the mind. And I don't think they understand what they're going to be getting into and how technical it's going to be. And we're actually seeing now that some loan funds that submitted earlier in the process are getting denied. And these are loan funds that have been around for decades, have done great work in their communities. There's no question about them being good CDFIs, but they're just not hitting the technical boxes.
Mm,
So what we anticipate seeing is, I think the world of CDFIs is going to shrink. I think there are going to be fewer CDFIs, which is good news for those who can get through the process. They're going to have access to around a comparable amount of resources, and there's going to be less competition for those resources. But you
mm.
hate to see good CDFIs not be able to maintain the designation.
Yeah, yeah, for sure. And I mean, I think the purpose of the reg change was to ensure that CDFI credit unions were actually doing CDFI work, not just credit unions, banks, and loan
Mhm.
funds as well. Um, but yeah, it turns out that ends up pulling resources away from other institutions that really need it to continue functioning. So, kind of a double-edged sword there.
Yep.
And So one of the things I noticed you said when you were talking about the target market area, there's a lot of focus on lending, and obviously capital helps. Capital investment will help build the community and individuals when used properly. So, what about savings and things like that? Is that also a part of the requirements for the CFI?
It plays a role, maybe not as large a role as we'd like to see. CU strategic planning has been, I'll say, encouraging the CDFI fund for a long time to recognize that CDFI work and community development work is not just lending, it's also deposit services.
Hmm.
Having free access to a checking account is a big deal. It
Hmm.
keeps you from having to go down to the check casher at the gas station and pay 5% every time you want to cash your paycheck. I would say that the CDFI fund has recognized that benefit to some degree in the new regulations. The way it did that is it said, okay, CDFI depositories, if you can show that a significant number of your depositors are in your target market, then we'll give you a break on the lending requirement. So in general, your lending needs to be 60% of the target market. That's both 60% by number of loans and by dollar volume of lending. The fund said, if you can show that at least 60% of your depositors are in your target market, then they'll lower one of those 60% lending requirements to 50%. So
Hmm.
typically what we'll see is we'll review a list of depositors from the credit union, might be 70%, 80%, whatever it is, are in the target market. That allows us to go back to the CDFI fund and say, okay, the rule now for this credit union is 60% of their number of loans needs to go to the target market, but only 50% of their dollar volume lending needs to go to the target market, making it easier to meet that requirement.
So one of the new things that was required in the CDFI's certification and recertification is to have an advisory board. Can you talk a little bit more about what's required there and maybe is that difficult? How is difficult? How is it helpful?
Right? Thankfully, it's not a strict requirement, but it is an option. So what the CDFI fund requires is that the CDFI show what the fund calls accountability.
Mhm.
It's a technical word. I like to use the word representation instead because I think that's what they're really getting toward to. You can meet the representation requirement either through your board of directors or through an advisory board. So the first stop is we look at the board of directors to see if those target market components are represented and a sufficient amount of your board represents the target market. A lot of credit unions have that box checked already. Great. We typically don't move on to the advisory board then. If they don't, though, then the next stop is the advisory board. The benefit from just a compliance standpoint is that when you have your board of directors, it's already set, right? And
Mhm.
changing a board of directors is not an easy or short-term task, but you can form a new committee
Mhm.
relatively quickly. So what we're helping our credit unions do who need the advisory boards is go out into the community, identify community members that are either aware of the needs and challenges that are out there or helping to meet those needs and challenges, have something to say about those needs and challenges, and inviting them onto this advisory board to meet that representation requirement.
Mhm.
Frankly, it can be a time-consuming lift. You're going around looking for people that meet the requirements, but are also going to be a good fit for your credit union, a good fit for the group on the advisory board. It does take some time. We do think that it's something that's going to pay off, though, for credit unions. I think there are a number of potential benefits besides having a closer connection to the community and having a new perspective, new source of ideas. These are folks that you're getting to know better and might even be a step on towards moving towards your board of directors.
Mhm.
We've seen that a lot of credit unions are inviting heads of nonprofits
Mhm.
or community partners that they've wanted to have deeper relationships with. What better way to get a deeper relationship with an organization than having that person on your advisory board and seeing them multiple times per year?
Mhm.
And for the right partner, that can be a good lending pipeline to come in and at that point then having multiple conversations has really paid off for the bottom line and for service to the community.
Yeah, absolutely. Because those either they're like, are they required to be your members, the advisory board?
They're not. They're not.
Okay.
So it's wide open.
Okay, that's good to know too.
Yeah.
Um, but how is this? I guess have you are when are they required to have, or are they already have been required to have the advisory board set up?
The ones who need it, it just has to be in place before the recertification application
Okay.
is submitted. So with the credit unions we're working with, the vast majority, we have those are in place because we're going to be submitting most later this month. For those that might be wanting to submit in September on their own, they just need to have the policy in place and all of the advisory board members approved by their board of directors before they hit the submit button on that recertification application.
Okay. And is there a required number to have on the advisory board?
There is. That's something if a credit union is looking at this on their own, they need to create a checklist and go down the checklist, make sure that each item is checked. This is one of the major reasons that loan funds are getting recertification applications denied is because they're not checking all of the boxes.
Mm-hmm.
One of them is a number of members. It has to be at least five
Mm-hmm.
and then at least 60%. So three of the five need to be accountable to the target market.
Okay. Yeah, it makes sense. Um, well, I always allow my guests the final thoughts. So how would you like to close out your discussion here with our credit union audience?
Uh, I'd say it's been a rough couple of years. We know that we've seen it, but all the signs are pointing to a bright future.
Hmm.
We quite frankly are in the midst of probably the most antagonistic administration to the what the CDFI fund has done in memory, and even in that environment, we're still looking at being funded at a high level, still looking at all the major programs being there. So if we can survive this, we can survive just about anything. All the hard work that's gone into this, it's been very time consuming. I have a lot of respect for the credit unions that have stayed the course, have gone through it, and I think that we have bright days ahead.
Awesome. Well, thank you so much. Good to hear that. Good to have you.